Why do central bank policies affect bond markets? In today's financial world, the question on many people's minds is why central bank policies have such a significant impact on bond markets. With inflation rates fluctuating and interest rates being adjusted, understanding this connection is more important than ever. Just yesterday, the Federal Reserve announced its latest decisions regarding interest rates, which sent ripples through the bond market. So, what does this mean for you and your investments? Central banks like the Federal Reserve in the United States play a vital role in shaping economic conditions. Their primary tool is adjusting short-term interest rates. When the Federal Reserve raises interest rates, borrowing becomes more expensive. This often leads to higher bond yields, which can affect the value of existing bonds. On the other hand, when rates are lowered, bond yields tend to decrease, making bonds more appealing to investors. Inflation expectations are another key factor. Central banks typically target an inflation rate of around 2%. If inflation expectations rise, investors may demand higher returns on bonds to offset the anticipated decline in purchasing power. Conversely, if inflation expectations drop, bond yields may also fall. Central banks also utilize various monetary policy tools, such as quantitative easing. This involves purchasing assets to influence long-term interest rates and inflation expectations. These actions can directly affect bond prices and yields by changing the supply and demand dynamics in the bond market. Economic growth and stability are central to the goals of central banks. Their policies can influence consumer spending and business confidence, which in turn impacts bond market performance. For example, if economic growth appears to be slowing, bonds may become more attractive as a safe investment, potentially lowering yields. Market sentiment is significantly influenced by central bank communications and policy decisions. Any uncertainty or changes in policy can lead to volatility in the bond markets as investors adjust their expectations regarding future interest rates and inflation. Inflation is at the heart of these dynamics. Central banks must carefully balance controlling inflation with supporting economic growth. Their policies directly impact bond markets by influencing interest rates, inflation expectations, and overall economic conditions. Understanding this relationship is essential for anyone looking to navigate today's financial landscape effectively.